If someone asked me to choose just one investment that I could keep buying for the next 20 or 30 years, my answer would simply be the exchange traded funds, also known as ETFs. And this is because ETFs give you the opportunity to own pieces of many successful companies at the same time without having to choose one individual winners yourself. In this video, I will explain everything you need to know about ETFs in the simplest way possible. We will cover what ETFs are, how they work, why it is loved by many investors, their advantages and risk involved, and how Nigerians can buy foreign ETFs step by step. And finally, I will share some of the best ETF beginners should research before investing. If this is your first time on this channel, you are welcome to the channel. My name is Helen. I'm a money enthusiast and a financial literacy advocate. And on this channel, we talk about saving money, we talk about building wealth, investing, and making smart financial and life decisions. So if that's the kind of content you enjoy, don't forget to subscribe and turn on the notification so that you never miss any of our videos. Now let's get started. What exactly is an ETF? ETF simply means exchange traded fund. Think of it as a basket filled with different investments. Instead of buying shares in only one company, an ETF allows you to buy small piece of many companies all at once. This investment may include stocks, it may include government bonds, corporate bonds, gold, oil, or even a combination of different assets. Instead of putting all your money into one company, you are buying a collection of companies in one single investment. This makes investment much easier, especially for beginners. One of the most popular ETFs in the world is the Vanguard S&P 500 ETF, commonly known by its ticker symbol as VOO. This ETF invests in approximately 500 of the largest companies in the United States. Companies like Apple, Microsoft, Amazon, Nvidia, Alphabet, and many others. When you just buy one unit or even a fraction of 1 unit of VOO, you automatically own a tiny share of all those companies. Just imagine that. Instead of trying to predict which company will perform best, you are investing in hundreds of successful businesses at once. Another interesting thing is that ETFs trade on the stock exchange, just like ordinary shares. You can buy them during market hours and sell them whenever you choose. That flexibility is one reason ETFs is preferred. Now that you understand what an ETF is, the next question is, how do you actually make money from it? There are two main ways to make money from ETFs. Number one is through capital growth. This is the most common way investors make money because when the companies inside the ETF grow and become more valuable, the price of the ETF also increases. For example, if you bought an ETF at, let's say, $100, and after a few years, it rises to $150, you made a profit of $50 per unit. Of course, prices don't move in straight line. Some years the market goes up, while other years it falls, and that's completely normal. The number two ways to make money from ETF is through dividends. When you purchase ETFs that invest in companies that pay dividends, those companies share part of their profit with you as a shareholder by paying out dividends on the ETFs you hold. And depending on the ETFs, those dividends may be paid directly to you as an investor or automatically reinvested to buy more units. And that allows your investment to grow even faster over time through the power of compounding. So at this junction, if you haven't liked this video yet, please give it a thumbs up. It helps the channel reach more people. Thank you for doing that. The next question on your mind right now might be, can ETFs really generate good returns? Yes, it can, but it's important to have realistic expectations. Historically, broad market ETFs that track major stock indexes such as S&P 500 have delivered an average annual return of around 14.9% over the long term. Some years have been exceptional with returns above 20%. For example, during strong market years, investors have enjoyed returns of over 25%, although the market has also fallen by more than 50% in difficult years. But The key lesson here is that you shouldn't judge an ETF based on 1 year. Successful ETF investing is a long-term strategy, and the longer you stay invested, the more time your money has to recover from market downturns and benefit from future growth. You should consider ETFs for some reasons. For example, number 1, for instant diversification. And this is probably the biggest advantage, because if an ETF owns shares in 500 companies, it is highly unlikely that all 500 companies will perform badly at the same time. That's why ETFs are generally considered less risky than investing in a single stock. The second reason you should consider to fall in love with ETFs is its lower investment risk. Yes, the risk is lower compared to stocks, but let's be clear. ETFs are not risk-free. The prices still go up and down because they are linked to the financial market. However, because they contain many investments, they are usually less volatile than buying shares in just one company, and that makes them a good option for beginners who wants to expose to the stock market without taking unnecessary risk. Another reason ETFs are popular is their low cost. I mean the management fee. Every investment fund charges a management fee called an expense ratio. Many actively managed mutual funds charge around 1% or even more each year, while most ETFs charge significantly less, ranging from maybe 0.03% upward. That means more of your money stays and continues working for you instead of being used to pay high management fees. And over many years, those savings can make a noticeable difference in overall returns. Now, the fourth reason is that it is very easy to invest in. One thing I personally like about ETFs is its simplicity. You don't need to spend hours researching hundreds of companies or worrying about which stock to buy next. Once you've selected a quality ETF that matches your goals, you can continue investing regularly and just allow time to do the heavy lifting for you. So this approach is called buy and hold investing, and it has helped many ordinary people build wealth over the long term. Reason number 5 is you can buy and sell easily. Unlike some investments that lock your money away for years, ETFs are traded on the stock exchange. That means you can buy or sell them whenever the market is open. So if you decide to cash out your investment today, you simply place a sell order through your investment app. And once your order is executed, the proceeds are credited to your account directly. So this flexibility makes ETFs very, very convenient. At this point, you may be wondering, Helen, there are thousands of ETFs available in Nigeria. How do I know which one is right for me? That's a very important question to ask, because not all ETFs are the same. Each one is designed for a different purpose. Now, let me quickly say 6 things you should consider before you choose. Number 1 is to start with your investment goal. You should ask yourself why you want to invest, alright? Your answer will now determine the type of ETF suitable for you. For example, if your goal is long-term wealth creation, you may prefer a broad stock market ETF. If you are approaching retirement or you prefer lower risk, you might consider bond ETFs due to its lower risk. If you believe a particular industry, such as maybe technology or healthcare, will grow significantly in the future, you can invest in sector ETFs. Just ensure your investment always matches your financial goals and your tolerance for risk. Number 2 thing to consider is you must understand the different types of ETFs. There are many categories of ETFs. For example, the bond ETFs, which invest in government or corporate bonds, and they usually experience less price fluctuation than stock ETFs, which make them attractive to more conservative investors. Another type is sector ETFs. This one focus on one particular industry. It may be technology industry or artificial intelligence or healthcare or banking or energy or even real estate. So if you strongly believe a particular industry has a bright future, a sector ETF allows you to invest in several companies within that industry instead of choosing just one. We also have commodity ETFs, and this category invests in commodities like gold, like silver, like oil. Many investors usually use commodity ETFs to diversify their portfolios or to protect themselves during periods of inflation. We also have stock ETFs and so on. Just ensure you understand the type you are investing your money. Now, the third thing you should consider before investing is to look at what the ETF owns. Please never invest in an ETF simply because someone recommended it. Always take a few minutes to find out the company or assets inside the fund. Ask yourself which companies are included. Ask if you believe those businesses have long-term potential for you. I hope you understand. And also be sure you are comfortable holding them for a long period of time. Okay? And most ETFs providers publish their holdings online. So all this information are easy to access. Now, number 4 is check the expense ratio. Earlier, I mentioned that ETFs generally have low fees. However, the fees are not exactly the same. The annual management fee is called the expense ratio, and as a general rule, lower costs are better because they leave more of your investments working for you. Although the difference may seem very, very small, but over 20 or 30 years, it can significantly affect your total returns. Number 15 you should consider is their past performance. Although past performance does not guarantee future results, however, it can help you understand how the ETF has behaved under different market conditions. So check if it has grown consistently over the years. Check how it performed during market downturns and if it had recovered well after the previous decline. This information gives you a better picture before making your investment decision. Number 16 is consider the size of the fund. Generally, larger ETFs with billions of dollars under management tend to be more stable and easier to buy and sell. This doesn't mean smaller ETFs are bad, but I feel more comfortable starting with larger, well-established funds. So before we move to buying an ETF, let me quickly mention a few mistakes I see many new investors make. First is investing without understanding what they are buying. Always learn about an investment before putting your money into it. Second, expecting to become rich overnight. ETFs are designed for long-term investing. They help you build wealth gradually, not instantly. Number 3 thing I see they do is checking investments every single day. The market moves up and down daily. So if you are constantly monitoring short-term price changes, it can lead to emotional decisions. Number 4 thing is putting all your money into one investment. Even when investing in ETFs, it's wise to build your portfolio gradually and maintain some diversification. The goal isn't to chase quick profits. No, the goal is to grow your wealth steadily over many years. Now comes the practical part. You've learned what ETFs are, how they work, and how to choose one. The next question is, how do you actually buy an ETF in Nigeria? We will start with dollar ETFs today. The good news is that you don't need to travel abroad or open a foreign bank account. So for this demonstration, I will use Pluto's Neo, formerly known as Optimus by AfriInvest. But the process is very similar on most investment apps. Step number 1 is to create and verify your account. If you don't already have an account, just download the app from Google Play or Apple app. Sign up with your email address and complete the identity verification process. This is a standard requirement that helps protect you and as an investor and also comply with the financial regulations. Step number 3, search for the ETF after funding your account. Use the search feature to find the ETF you want. For example, you can search for VOO, you can search for SPY, QQQ, or VTI. Just open the ETF and take a moment to review the information provided. You will usually see details such as the companies or the assets it holds, the historical performance, you will see the risk level, you will see the current market price, and a brief description of the fund. Please don't rush this step. Spend a few minutes to understand what you are investing in. So step number 4, decide how much you want to invest. One misconception people have is they think they must buy an entire unit of an ETF. That's not true. Many investment platforms allow you to buy fractional shares, meaning you can start with a much smaller amount instead of paying for the full unit, you understand? So this makes ETFs accessible even if you are investing with a modest budget, rather than waiting until you have a large amount of money. Consider starting with what you can comfortably afford and invest consistently. Step number 5, Place your buy order. Once you've entered the amount you want to invest, review your order carefully. Check the ETF you are buying, the amount you are investing, any transaction fees, whatever on the app, the estimated number of units or fractional units you will receive. If everything looks correct to you, confirm the purchase. So if the market is open, your order may be executed almost immediately. US market in Nigeria is usually open between 2:30 p.m. and 9 p.m. during working days. If the market is closed, your order will usually remain pending and be processed when the market opens. Step number 6, after your purchase is completed, your ETF will appear in your portfolio. From there, you can monitor its performance over time. Just remember, ETFs are generally designed for long-term investing. Don't panic because prices go down for a few days or even a few months. Market fluctuations are normal. Long-term investors focus on years, not days. Now, how do you sell an ETF? Selling is just as simple. Open your portfolio, select the ETF you want to sell, enter the amount or number of units you wish to sell. Review the transaction and confirm your order. If the market is open, the sale is usually processed very, very quickly. If it's closed, your order will normally be executed when trading resumes. Before we end this video, let me share a few ETFs that many long-time investors around the world consider worth researching. If you are planning to start, please know that this is not a financial advice. So every investor has different goals and risk tolerance. So always do your own research before you invest. Number 1 is the VOO, Vanguard S&P 500 ETF. If you are looking for an ETF that gives exposure to some of the biggest companies in the United States, VOO is a great place to start. It tracks the S&P 500 index, meaning you indirectly invest in 500 large US companies, including businesses like Apple, Microsoft, Nvidia, Meta, Alphabet, and many more. VOO has broad diversification and low management fees. In fact, their expense ratio is only 0.03%, which is very, very good. Number 2 is VTI, which is the Vanguard Total Stock Market ETF. See this one, why VOO focuses on first 500 large US companies, VTI goes further. It gives exposure to thousands of companies across the US stock market, including large, medium, and small companies. We are talking of about 3,500 strong companies. So if you want to own almost the entire US market in one investment, this is one to research. The third on my list, especially if you are interested in technology and innovation, is QQQ, meaning Invesco Nasdaq 100 ETF. The QQQ is a popular option as it invests heavily in leading technology companies such as Apple, Microsoft, Amazon, Broadcom, and others listed on the Nasdaq exchange. But because it has a stronger focus on technology, it can experience larger price swings than broader market ETFs. Number 4, if your goal is to earn regular dividend income while still enjoying long-term growth, the SCHD, that is the Schwab US Dividend Equity ETF, is worth looking into. It invests in established companies with a strong history of paying dividends. You can consider including dividend ETFs like SCHD as part of your balanced long-term portfolio. Number 5 is the Vanguard Total International Stock ETF, which allows you to diversify your portfolio beyond the United States. It means you are investing in companies across Europe, across Asia, Canada, Australia, and many international markets. And this adds international exposure that can help reduce concentration risk over the long term for you. So if there is one message I want you to take away from this video, it is this: you don't have to be wealthy before you start investing. The most important thing is to start early. Invest consistently and give your money enough time to grow. If you found this video helpful, please don't forget to give it a thumbs up. It really helps the channel. Also subscribe if you haven't already, because every week I share practical videos on saving, on investing, on wealth building, and personal finance. I'd also love to hear from you. Have you invested in an ETF before, or are you planning to start after watching this video? You can also tell me which topic you want me to cover next. Let me know all of this in the comments below. Thank you so much for watching with me today, and I'll see you in the next video. God bless you.